Hello, boys and girls. Hope everyone is doing good. I am Rimas Eesa, one of the directors of Platinum Business Academy. I teach the subject accounting, and I have been teaching for the past 10 to 11 years for London O-levels and A-levels. And I have also taught for ACCA certain subjects in the past, not anymore. Hopefully in the future, I might teach as well. So today I'm going to give you a small introduction of this topic, investment appraisal. Okay, I'm going to do a small demo and give you an introduction about a topic named investment appraisal. Now, what happens under this investment appraisal? Before you undertake any investment, you have to think a bit, right? Whether this investment is going to give you sufficient returns, okay? With basically whether it's worthwhile making this investment. To make a conclusion, to come to a conclusion with that, there are certain things that you need to calculate, right? The payback period, accounting rate of return, okay? The net present value, IRR. There are so many things that you need to calculate, but initially I'm going to teach you how to calculate the payback period, okay? Now, I've given you a basic example over here. It says planning to invest on a machinery costing 100,000. Useful life is going to be 5 years. So you're planning to buy a machinery, which you can use it for 5 years. And you have forecasted the inflows and outflows that might arise as a result of this investment. Okay, so you can see cash inflows and outflows for the 5 years. But remember one thing, these are the forecasted figures. Okay, for you to make a decision, you do a small calculation in advance and see. So in reality, definitely these are not going to be the figures, but this is just for a bit of decision making. Okay, so if you are going to use a machinery, you use it for production. So for production, you need to incur some cost, no, right? If you are incurring some cost, those are going to be the cash outflows. You have to pay money for it. And these items, once produced, you will be able to sell it. So when you sell it, you get some money. So those are going to be the inflows, right? First, I'm going to teach you how to calculate the payback period, right? Payback period. You know what is payback period? How long will you take to recover the investment of 100,000? It can be 1.5 years, it can be 2 years, it can be 3 years, right? How long will you take to recover your investment? That is what you mean by payback period, right? Now, in this question, before you start calculating the payback period, you need to calculate something called net cash flow. You know what is net cash flow? Let me do a small calculation. You have the year. So I'm going to calculate my net cash flow, right? Net cash flow. So year 1, 2, 3, 4, and 5. Net cash flow is inflow minus the outflow. So if you look at year 1, you got 60,000, no, but you are spending 30,000, no. So how much will be the balance? How much will you be able to accumulate at the end of year 1? You will be having 30,000 with you, right? So at the end of year 1, your net cash flow will be 30. What will be the net cash flow for year 2? Inflow minus the outflow. 90 minus 40, that will be equal to 50. Year 3, 80 minus 40, that will be equal to 40. Year 4, 70 minus 30, that will also be equal to 40, right? Year 5, 100 minus 50, that will be equal to 50. So before you calculate the payback period, the first thing you need to calculate the net cash flow. How do you calculate the net cash flow? Cash inflow minus the cash outflow, right? So that is done. Now, what is payback period? How long will you take to recover the investment? Your investment here is 100,000, right? So the cost of the investment for you over here is 100,000. You need to find out how long will you take to recover the 100,000. Now, if I ask you a question, during year 1, how much money did you get in total? 30,000, right? The net amount, right? After spending for all the cash outflows, you were able to accumulate 30,000, right? So after spending 100,000, now you have got back 30,000. So you remove it from this. You are getting back 30,000, which means you have recovered 30,000. Harida. So 100 minus 30, your answer will be 70,000. You need to recover another 70,000 more in the future, right? So after year 1, 30,000 is recovered. Now I move to year 2. What is the net cash flow for year 2? 50,000, right? So during year 2, you are able to get another 50,000. So which means you need to recover another 70,000 more. But at the end of year 2, you are getting back another 50,000, which means in the future, you have to recover only 20,000 more, right? So far in total, 80,000 is recovered. Year 1, 30, year 2, 50, right? So from 100, if you have already recovered 80, you need to recover only 20,000 more. Now I'm coming to the third year. I think there will be a small problem here. Look at year 3, your net cash flow. If you look at the net cash flow for year 3, that is 40,000. Look, you don't enter 40,000 here. You don't enter 40,000 here, right? The reason being, you need to recover only 20,000 more, right? You need to recover only 20,000 more. But what's happening in year 3, you are getting a total of 40,000. During year 3, you are getting a total of 40,000. You need to find out now how many months will you take to recover only the 20,000. Common sense, but I'll tell you how to get the answer using the formula as well. If you are getting 40,000 for 1 year, to get 20,000, you need only 6 months. Correct? No? If you are going to get 40,000 for 1 year, right? If I ask you, how long will you take to get 20,000 approximately, right? 6 months, right? That will be the answer. 20,000 for the first 6 months, 20,000 for the second 6 months. In total, you will get 40,000. But how to get that number of months calculated now, right? I'm going to do a small working here. You take the amount that you need to recover. How much more you need to recover? You need to recover only 20,000 more, right? So I take that 20,000 here, divide it by, right? Divide it by the total amount that you recovered. How much is the total amount that you got during year 3, right? During year 3, because you are working for year 3 now, right? How much is the total amount that you got during year 3? 40,000. You need to get only 20,000. Take that, divide it by the total amount that you got during year 3. And then multiply it by 12, you will be getting 6 months over here. This calculation will give you 6 months, right? So what is the payback period? Payback period is how long you took to recover the 100,000, your investment, right? So how can what is the answer here? My payback period is going to be, right? My payback period is going to be, I am taking 2 years. 2 years and 6 months exactly, right? 2 years and 6 months to recover the 100,000. This is one of the methods that you apply and see before undertaking any investments. Okay. So your answer, payback period is 2 years and 6 months. Okay. Now, if I ask you a question, when it comes to payback period, okay, 2 years and 6 months is better or 2 years is better? Definitely you will tell me 2 years is better. Faster you can recover your investment, definitely better for the business. Okay. So your payback period should be as quick as possible. Then based on payback period, that is the best project that you can take up. Okay. There are other methods as well, but before that, what is a major concern when it comes to payback period? I told you at the start that all these are your forecasted figures, budgeted figures, and these are not your actual figures. No. So if this is not your actual figures, in reality, the cash inflows which I have given, cash outflows which I have given will be different. So in reality, if the inflows and outflows are going to be different, the payback calculation that you did will also be different. It could be faster than 2 years and 6 months, or it could be even slower than that, could be even 3 or 4 years. Okay, so you never know. So that is one of the major drawbacks of payback period. Okay, so what did we do? Before undertaking an investment, we need to make certain decisions. Okay, one of the factors that you need to consider is how long will you take to recover the investment, which is the payback period. Then you need to look at how much profit this investment might give you. That is, you do a separate calculation called ARR. Okay, then there is something called NPV, IRR. There are different techniques that you need to apply and apply before you make a decision, right? So I have given you an introduction about this investment appraisal, and under investment appraisal, I just did one calculation with you. Remember, there are others as well, but within the time that is given to me, that's all I'm doing with you all. Hope you find it useful and hope you gained some sort of a knowledge from this topic, investment appraisal. Thank you guys. Thanks for watching. Have fun. Enjoy life. Take care.